first thing I want to start with is when I was asked to speak, they said, okay, Chris, we want you to talk about markets. So the first thing that came to my head was fruit, because of course that's what you think of. And by the way, you guys, your insurance is paid up, medical is okay? Because I've been on both sides of the equation. I've sat in your seat, and I do a lot more presentations now. And whoa, there we go. My face is off there because that's embarrassing. And I do a lot of presentations. And a picture's worth 1,000 words, but a guy making a fool out of himself, that's worth a lot more. And I want to tell you what I see in the capital markets right now. So if you think about this, this is monetary policy. This is fiscal policy, and this is the economy. And I want to see if I can get this right. So may need 1 or 2 tries. So right now, what you're seeing, oh my God, those lights. You can't, I'm sorry, I didn't account for that. So just make believe I'm juggling, right? And everything, we'll try it one more time, and everything's going great. Now what you're doing is you're taking monetary policy off the table, and those lights are still blinding, and you're having something good. But as you can see, you can easily go from juggler to clown like that. And that's one of the things we're worried about. And that's one of the things we're looking at. Anybody want a lime, lemon? We're good? Holy cow, didn't expect that. Sorry. And so as we look into the capital markets, as we look into the equity markets, what do we see? And what do we think? What we see is a market where everything is expensive. The 10-year is at 2.4%. Investment grade credit spreads are what you pay above for corporate debt, 100 basis points over, historically tight. If you tack on a healthy 3% risk premium, that puts you at mid-single digit returns for risk products or for equity products. And that's what we think you're going to get for the next 12, 24, 36 months. Now, some of my peers are much more bullish, and they say things are going to be great. I am much more realistic, I think. And what I want to show is what we see in the capital markets at this point in time and why we think the way we think. Everything's great, and that's the problem. Everything's great at this point in time. So let's hit some. Okay, so here are big themes. We'll touch on a few of this. Again, our price target. You guys don't care about price targets. Just think mid-single digit returns. That's what we're going to get. Okay, assets are expensive. When assets are expensive, what do you want to do? What's one of the best risk rewards? Is to move up in quality. Or that's what we think is to move up in quality. And we'll talk about what that means and what that looks like. Passive is the new Q. We're going to digress at some point in time because passive is such a big part of the marketplace right now, and it's doing something very dynamic. And it's something I hadn't thought about or talked about for a while, and then we kind of fell upon this and discovered this. And then what we want to do is, pointer, you can do this or not. We want to go back and say, okay, what happens during a Fed tightening cycle? What happens to growth? What happens to multiples? What happens to the yield curve? Okay, and why is that important? And then we'll talk a little bit about what capital. So there's talk about repatriation. There's talk about money coming into the market. What does that do? And again, how has the monetary environment affected what we're going to do going forward? And one of the things I want to talk about is a creative destructive process or how the creative destructive process was retarded and how that's going to lead to M&A. I also want to talk a little bit about utilization rates and inflation as well, because I think that's important. One thing I forgot to mention, I have 3 brothers, a very big family. Everyone in my family has Tourette's, so during the holidays, people yell and scream and talk at each other. If somebody wants to join in or somebody has a question, just shout it out. And as I was saying before, I was talking to some of the business students. People ask me, so what do you do? And it's a little hard for me to explain that, but one of the things I do is I handicap everything. And I'm not just an equity strategist, I'm more of a capital markets strategist. So if you have a question about fixed income or equities, except for somebody asked me about cryptocurrencies. We're not going to talk, there we go. We're not going to talk about cryptocurrencies. But other than that, just jump right in. So a lot of numbers on this page, and we don't want to go through it, but the important thing is, as we look at this, and let me see. Okay, as we can see, and what we were talking about is treasuries are expensive. 2.3, 2.4%. Investment grade credit spreads, historically tight, 1% or slightly less than 1%. And you tack on a healthy risk premium, in this example it's less than 2%, equities, the equity return you're going to get going forward is still rather pedestrian. Everything is expensive, and I can't emphasize that enough. Now, I'm going to skip all the way back, or to the back of the presentation because I get this question a lot, and it's that one. So everyone, if you look in the late 90s, people say, wow, multiples have expanded. You know, the equity market's going to blow up. You're having global growth. You're going to have a tax cut. The Fed's still very aggressive. Well, why won't we have the late 90s? Well, if you look at the late 90s, GDP was consistently in and around 4%. Credit spreads were historically tight. Rates were a little bit higher, but still historically tight. And ISM was consistently high as well. What you see in 15, 16, 17, tight spreads, exceptionally low rates, no inflation, but GDP is 2% in a cloud of dust. And that's what you should expect going forward. Yes, you can get a short period of GDP at 3%, at or above 3%, but we're a mature economy. It takes a ton to push us up, but the good thing is it takes a ton to push us down. 2% GDP, that's more or less what you should expect. Lastly, when I talk to people, what we were looking at back then was the beginning of the internet in some cases in 98, 99. We're not sitting on that. Google, Facebook, Amazon, these are all very mature companies. I don't see how we have a repeat of 97, 98, 99. Okay, so what happened? So let me talk my book a little bit. So here's why we're thinking we're a little more conservative than the average person. So what happens in a Fed tightening cycle? And what you can see in the shaded areas are the tightening cycles going back to 86. And we have year-over-year EPS growth, and we have ISM manufacturing. You do the quote-unquote ocular regression, and what do you see? You see growth peaks in and around the tightening cycle, which intuitively makes sense. So now the question is, as I look at the capital markets, as I look at equities, yes, I'm going to get some sort of double-digit growth rate next year. What multiple do I put on that? And the second thing we see is the curve flattens. Every time we've been in a tightening cycle, the curve flattens. So with that, we have lower growth, and we have a flatter curve. So the multiple that we're putting on things is much lower than we have in the past. And so even though we have positive growth, we're putting a lower multiple on things. Because again, as things start to decelerate, as accommodation comes up, you don't put a higher multiple on things, it's a lower one. The second thing I wanted to talk about is taxes. Everyone's really excited about taxes. Everyone's all gaga about taxes. But when you look at the House, and there was some talk about taxes before this, when you look at the House bill and you look at the Senate bill, in the House bill, taxes or corporate taxes get done in 18. In the Senate bill, corporate taxes get done in 19. What appears to be happening, and the people who have the leverage, are the folks in the Senate. So if we don't get the tax change, now we'll get some taxes on the consumer side, but if we don't get the corporate tax change in 18, you have to reprice risk not very aggressively, but you have to start pushing it back, and the value of that starts to go down. And the market is not thinking about this, it's not pricing this in. So let me skip over. So now the question is, okay, if I'm right, and that's a big if you're going to get 5 or 6% in the equity market for the next 1, 2, 3 years, what's your best risk reward? Where's the opportunity? And as we were saying before, the opportunity is up in quality. And when I talk about up in quality, it's companies that have lower leverage, companies that have high ROE, more efficient. It's companies with better profit margins, if you will. They're not real sexy, they're not real exciting, but this is about capital preservation, and this is about eking out additional returns. 2% on 5% is a lot more attractive than 2% on 20%. In addition to that, what quality does for you, it allows you to participate to the upside, but really protect on the downside. And one of the things I keep hearing from clients all the time is I have FOMO. I have fear of missing out, right? And they're right to a large degree. The equity market, we thought you would have a double-digit return in 2017. We've had that and more. And clients are saying, I don't know how far it goes, so I don't want to get out. And my clients are saying to me, Chris, I don't want you to de-risk. I don't want you to get out because I'm afraid that the market's going to continue to go higher as we move into cash. And so it's a great opportunity, or it's a great strategy for situations like we have today. Now what's interesting is two things, from a valuation point of view and from a credit spread point of view. So from a valuation point of view, what we've done is we've looked at high quality and low quality, and we've looked at the valuation over time. Now, high quality is generally more expensive than low quality. You have to pay up for it. The question is, are you paying through the nose? And that's that graph on the left-hand side. That's the spread between high and low quality. What you can see is that spread has compressed. So you're not paying through the nose. If you go back to 08, 09, you really had to pay up for quality. So one, that's very attractive to us. Two, and this is more important, credit spreads. So whether it's high yield or investment grade credit spreads, they're historically tight. A massive spread compression has been the Achilles heel to quality. Some of you may have heard this phrase bandied about before, but back in 2009, there was a phrase people used, a dash for trash. And what that was is low quality companies really outperformed the market as credit spreads came crashing in and we had a risk on period. Here we have almost the exact opposite, where credit spreads are historically tight and really can only grind tighter. It's almost physically impossible for them to stage a very big or precipitous drop down. So now you have the major macro risk taken off the table. To us, this is a very attractive situation. I want to focus in on the graph on the right-hand side. So the second thing that we do is we look at valuation. So some of you may know that value strategy, value products haven't done very well this year. And that to us is not a surprise, because again, what we do is we look at the cheap basket, a cheap basket versus the expensive basket. We look at the spread over time, because that allows us scope. How much scope are you going to have for multiple revision? How much scope are you going to have for repricing of risk, and so on and so forth? And what we see is that spread is historically tight. It follows a very similar pattern to credit spreads. And in that situation, what we need to see to get more excited about value is a widening. We need a repricing of risk for that to occur. The reason why I bring this up is, again, when you're investing in higher quality, you're making a negative bet on value. And in a situation like this, we're very comfortable with betting on quality, because we think value is going to be has been and continues to be in a very tough spot. People will say, okay, money's going to be repatriated. Money's going to come into the market, and where's it going to go? People will talk about CapEx, they'll talk about buybacks, dividends, M&A, so on and so forth. Our main theme is M&A. We think M&A is going to really ramp up in the first half of 2018. And there's a couple of reasons for that. One, we believe there's a lot of pent-up demand. So with taxes, or prior to taxes, what happened was the bid-ask spread started to widen out, because nobody knew exactly what benefit they were going to get from taxes, so people started to separate. In addition to that, you didn't know how to fund yourself or the cost of funding. So interest expense or the deductibility of interest expense was somewhat questionable. Now that we have a much clearer picture, and it's not 100%, but we have a much clearer picture, you can start to see that bid-ask spread come together. Now the other thing, and the more important thing, is the creative destructive process never occurred in its natural entirety. And what I mean by that is we had a massive recession, and that's my scientific term, massive recession. And we did have default rates, which is that graph on the upper left-hand side. However, central banks in the US and globally started to flood the market with liquidity and accommodation. And it became very hard to go belly up or to go bankrupt. So how do you rationalize capacity? Bankruptcy, growth, or M&A? Well, if you think about it, and I use this phrase all the time, some of the more high-profile bankers we've seen in recent years, Radio Shack and Toys R Us, not real big companies. And so it's not going to happen through bankruptcies. Even though the Fed is in a tightening cycle, the amount of accommodation that we have on the table is exceptional. Okay, so what else does that lead? Well, growth. Well, we're at 2% GDP growth and a cloud of dust for the last couple of years. Hard to grow. That's not a great growth rate. And that leads us to M&A. And so what we think is going to occur is a rationalization of the process through M&A. We think next year you're going to get a significant ramp up due to pent-up demand, due to the fact that we have a much better idea of what taxes or the tax benefit is going to be. In addition to that, there's liquidity, costs are cheap, and we're still only growing at 2%. Maybe we grow a little bit more, but right now, economic expectations aren't that attractive. So one of the things we're going to play out is M&A. People will say, oh, well, what about buybacks? And I say, we've been doing buybacks for a while, and it's the graph on the right-hand side. The market is not paying you to buy back your share, or it's not paying you very much to buy back your share anymore. CEOs see this, they know this, and they start to change their behavior. The other thing that we're seeing with buybacks, and Wells Fargo has a very big buyback desk, is that the corporations are realizing as my stock goes up, it becomes more and more expensive, it becomes less economic for me. And because of valuation, we're seeing less and less buybacks as well, which again pushes us back into M&A. Now, one of the things people say is, well, why don't people property, plant, and equipment? Well, that's this graph right here. What we're looking at, the lower graph, is the utilization rate, or the US capacity utilization rate. And that's pushed forward, right, 18 months, and what we have is CPI. And what you see, and it gets back to this whole creative destructive process, or what I think has occurred. Utilization is still historically low. We have too much capacity at this point in time, which is why we don't have inflation. So if you start to put money back into the economy, and there are some places that need it, no doubt we'll see CapEx go higher, but that's not going to be your first step to use capital. And people will always say, oh my goodness, the CEOs are trying to line their pockets. Yes, they have an incentive to raise their stock price and do better, but at the end of the day, they're not going to pass up a very good economic opportunity. And one of the things that they're saying by the amount of share buybacks that we've seen in the past is there's just not the opportunity to invest in. And this is something that we see. The Fed has said it's a mystery to us why inflation is so low. How it's a mystery to them, I have no clue. This is as simple as it gets. This relationship, again, if you do the quote-unquote ocular regression, you can see one time series lays on top of the other, and intuitively, it makes a ton of sense. Now, I just want to touch on passive quickly. So, as the head of equity strategy, I've written a lot about active versus passive, but more recently, what I'm talking about and whether active managers how much it should cost, where they should play, how the whole situation between active and passive plays out, so on and so forth. Now what we're saying is there's a different dynamic that's going on. It's the role that passive is playing, and it's the arb that a lot of the buy side is starting to do with active managers. And what I mean by that, and I threw up a phrase, passive is the new QE. People kind of scratch their heads, Chris, what are you talking about? What does that mean? So what that means is when we had QE, what did it do? With QE, you took a significant portion of the treasury market out of circulation, and you put upward pressure on price. Here what we're doing is passive for now is a one-way trade. Money's coming in, but it's not coming out. And so what you're doing de facto is you're taking a significant portion of the equity market out of circulation, putting upward pressure on price. And now what's happening with a lot of the active managers, and a graph or two in here. So these are some of the returns to large sections of the active management world. Active managers are having a very good year, and best year in 4 and 5. And some of the active managers are saying to us, Chris, it's a great year, but one of the things that we're having an issue with, every time we tried to sell and every time we tried to rebalance, it hasn't worked out. So we're stopping that. We're now on a seller strike. And I think what's happening is you have two dynamics in the marketplace. One dynamic is based on what I do and what many others of you may be doing. You make an allocation every month in your 401k or every quarter in your 401k. You set it and you forget it. It's not about valuation. It's not about price. It's about exposure. And so what the passive investors are doing, they're trying to find liquidity, source liquidity, and get exposure. On the other side of the equation, you have the buy side talking about risk reward, about fundamentals. And what's happening is the buy side is getting run over by passive, and passive is taking control. But the active management is not slow. They actually adapt very quickly. And so when things don't work, they generally slow them down, they stop. Now what we're seeing is they're actively starting to arb the system. They're realizing when passive comes in, how they come in, and where they want to, and they're being a lot more selective in what we're seeing, which is setting up another dynamic and another concern that I have. In the capital markets, the VIX is at 10, which is exceptionally low. It's been, the phrase I use, and it's not a great phrase, it's been shot and run over and shot and run over, it's been left for dead. And a VIX so low tells you that there's almost complete certainty, which is completely false, or there's not a lot of risk in the marketplace. Every day I come in, I see more and more risk, because what's happening is inertia is becoming one of the most powerful forces in the capital markets. A body in motion tends to stay in motion. One of the things that passive does is, for every dollar that went to the S&P 500 passive index fund this year, at the beginning of the year, 20 cents went to tech. By the end of this year, it was at least 25 cents that went to tech. There's a massive momentum component to what passive does. And the active managers are realizing it, and this is why they're stepping away and stepping back. The other thing that we're seeing on the active management side is everyone is crowded into the tech trade and the momentum trade, which is working, but to me, that's a big risk. In addition to that, portfolios, there's a lot of latent volatility in portfolios. As the VIX comes down, as volatility comes down, you put more and more risk into it, believing that tomorrow is going to be a lot like yesterday, and that just doesn't occur. And if I'm right, and we do have a big M&A wave in 2018, one of the things you're going to have to do is you're going to have to fund that. And as I was alluding to before, credit spreads are very tight. More paper will have to come in the marketplace, which should widen. Okay, more paper usually means supply-demand dynamics are a little bit upset. Wider prices. You're also going to have to provide incentive for people to come in. So you're going to have to issue paper that's more expensive. Usually, if you look at the volatility or the VIX and credit spreads that go hand in hand, you can see that widening go hand in hand with volatility starting to rise. And so one of the things that I'm worried about is that the market's not appreciating a lot of the interesting dynamics and a lot of the risks that are going in the marketplace. So to bring this all together and kind of recap, sorry, I'm not very good with a clicker. What do we want to do? What we're telling clients, lower your market expectations. Mid-single digit returns, about right. 2, move up in quality. This is the best risk reward that we think is out there. Equities, fixed income, what have you. And lastly, watch out for M&A. It's going to be a very, very aggressive cycle in 2018.